Mark Newton. I'm president and founder of Newton Advisors. My trade idea for today is buying gold, and specifically buying the GLD as a way to potentially profit as gold starts to break out in the weeks and or months ahead. Gold had already shown signs of breaking out of a long-term downtrend that began back in 2011 when gold and the majority of commodities peaked and began nearly a 5 to 6 year bearish trend. That since has started to stabilize, and we've seen breakouts of that downtrend in gold, which began last summer in 2017 and has been consolidating really over the last few months, and now is showing signs of generating a very constructive chart formation that I believe should lead to an upcoming breakout and lead gold up to at least 1550 or so in the months ahead. So we'll take a look at a few of the reasons surrounding why that should happen, but predominantly this involves Treasury yields stalling out with the 10-year right near 3% and turning back lower, along with the dollar also reasserting its bearish trend. So as the dollar moves lower, which we've seen throughout the balance of 2017, and what I expect to also continue throughout 2018, this should be a boon for commodities, obviously as commodities are priced in US dollars, and specifically with regards to the metals. They've really been a laggard thus far with what's happened with energy, but they're slowly but surely starting to show signs of bottoming out and rallying. You've seen the move already in some of the base metals. We've seen it in aluminum and copper and really palladium and platinum, but the precious metals really have lagged substantially in that regard, and I think it's time for them to catch up. But really a lot of this is going to be based on yields starting to stall out and turn down. Historically, we've seen when yields and the dollar both are falling, that typically is a great time to own precious metals, and I think we're very close to that happening. My play in general is to be long the GLD or IAU or any number of ETFs for those that don't play in futures and think that those are good vehicles to capture an upcoming rise in the price of precious metals, and specifically in gold. Gold looks attractive at current levels. When you take a look at the weekly chart, you can see that gold peaked out back in 2011. We had a 4-year downtrend followed by nearly a 3.5-year period of consolidation. This now looks to start to turn higher as the dollar peaks out in the near term and turns back lower, along with Treasury yields stalling out. Historically, we've seen times when yields have pulled back along with the dollar having weakened, such as what we saw in 2016, led to meaningful increases in the price of gold. My thinking is getting above 1365, which represents really the peak of this minor little, almost a 2-year period of consolidation, should lead up to a move right near 1550 in gold. So there are a couple of different ways of playing that. One, of course, is the GLD, the ETF for gold. And so if you buy here at a price right near 126, risking down near 120 or about 6 points on the downside, and looking to add to the GLD when it gets above the January highs of 129.51, my thinking is we can easily get into the level right near 145. So that's a decent risk reward for a trade like that. We can gain 16 points at a minimum, potentially 20 or more, and we're really only risking about 6 points to the downside. Historically, this works well when you take a look at the dollar. As I mentioned, the dollar pulling back. The dollar index right now has rallied a bit in recent weeks, but it's right up near levels that should be historically very important to suggest that this also starts to turn lower. So the dollar right here, the dollar index, which is about 63% versus the euro, has gotten up to 90, now showing signs of reversing course. So my thinking is it's ideal time to own gold as the dollar has rallied a little bit. We've gotten up to key levels. Now it should turn down and move down and take out former lows as part of its 8-year cycle. So historically, we've seen that commodities tend to have cycles of 8 years. They tend to trend in one direction. We last peaked out in the latter part of 2016. So we could potentially be lower in the dollar into about 2023. And if yields remain low, then that would be an ideal environment for gold. I'm not sure that the longer term economic growth will be so weak, but at least in the next couple of years, my thinking is rates can still remain low. Sentiment has gotten way too bearish on yields moving higher. People have gotten very short treasuries. So a declining dollar along with declining yields should be a great recipe for owning gold and thinking that gold starts to break out. So one can buy now as gold just in the last week has pulled down to a level right near 1325 in spot gold. And so when we look at the ETF, that coincides to a price of right near 126. When we look at the GLD, that should be an important level when we take a look at 126. And you take a look at several different trend lines just from last December, and they intersect right near current levels. So this really is a decent risk reward for thinking that the GLD starts to stabilize and turn higher, and really getting above these highs near 129 should allow for a move up into the early 130s, the low 130s, if not the 140s in the months to come. So time to get long gold, and I certainly don't think that gold has lost its luster. If anything, they should show signs of shining yet again in the months to come.